Hi, everyone, and welcome. This is Kevin Kincaid, and I will be your host for today's webinar entitled 7 Ways to Improve Your Personal Finances in 2018. Joining me today is Brittany Benassi, the Vice President of Financial Planning for AAFMAA Wealth Management and Trust. She will be sharing just about 30 to 35 minutes worth of slides with you today, and then we'll go through some questions and answers from the audience. And if you have a question, please go ahead and type it into the questions block on your screen at any time. Your phones will be on mute throughout. This monthly webinar series is brought to you by AAFMAA Wealth Management and Trust. Our vision is to ensure the financial security and independence of members of the armed forces community, active, retired, and honorably discharged service members and their families. We accomplish this by being the premier provider of financial planning, investment management, and trust services for all branches of the military. We are AAFMAA's trust company. AAFMAA stands for American Armed Forces Mutual Aid Association and is the longest standing not-for-profit association that empowers military families with affordable financial solutions. Also, as a trust company, we have an additional legal obligation to act as your fiduciary, which means we only act in your best interest and for your benefit. Here's an important disclaimer. This presentation is educational. It is for general information only and is not specific investment, legal, or tax advice for any of you individually. Do not rely on this presentation alone to guide your financial planning decisions. Since each individual situation is unique, your needs for financial services will differ. For individual advice, please contact us directly. We produce this webinar series in-house with our own professional staff as a service to our members and to help them better understand the resources that are available to them. I will now go ahead and turn it over to Brittany, who will review the agenda and start her presentation. Take it away, Brittany.
Thank you, Kevin, and thank you all for taking time to listen. I know you're busy during the holidays, so I appreciate your time. With the end of the year approaching, it's a great time to ask yourself if your financial house is in order and take steps to improve your personal finances. So today we're going to cover my top 7 items that you should consider, including reviewing goals, reviewing asset allocation, contributing to retirement plans, taking RMDs, year-end tax planning, updating your budget, and investing extra income. So first, review your goals and reprioritize as necessary. Establishing goals is the prerequisite for getting where you want to be, and it's important to take the time to define your family's financial goals with your spouse for the next year. So I encourage you to ask yourself, what are my financial priorities? What are my short-term and long-term goals? Short-term goals are things like a vacation, and long-term goals are things such as early retirement. Is there a particular budget category consistently over budget? When is the last time I looked at my investments or reviewed my insurance policies? Are there any unusually large bills next year, such as college tuition, a new roof? And then there's some other items here that I have on the screen that may not be as common, such as caring for parents and something like providing a legacy or saving for college. Some folks might be past that point or haven't gotten there yet. So now I want to move to the next slide, which is number 2, reviewing your asset allocation. Asset allocation is a common strategy that you can use to construct and manage your investment portfolio. Asset allocation isn't necessarily about picking individual securities, but instead focusing on broad categories of investments, mixing them together in the right proportion to match your financial goals, the amount of time you have to invest, and your tolerance for risk. So how tolerant are you of market risk? To understand your risk tolerance or how much risk you're willing to take, you first need to consider your time horizon and personal financial goals. The other aspect of risk tolerance is risk capacity, which is how much risk you can or cannot afford to take. Life events such as marriage, divorce, career changes, and retirement are just some examples of factors that should prompt an individual to reassess your risk tolerance. Generally, from a starting point for understanding one's personal risk tolerance, this is usually done by a risk tolerance questionnaire. A risk tolerance questionnaire asks several questions about various market scenarios whereby you, the investor, will anticipate your reaction to the given market scenario and answer the question accordingly. So AAFMAA Wealth Management and Trust offers a risk tolerance assessment on our website. I've put the link here. You're welcome to fill that out and view the results. Of course, models are intended to serve only as general guidelines, and determining your risk tolerance may require a conversation with a professional to help understand your personal circumstances and help you select the proper investment objective. So it's important to understand your tolerance for risk, but it's also important to keep in mind that your behavior is difficult to predict in advance. Many investors make the mistake of believing they are more aggressive than they actually are, and when the stock portion of their portfolio decreases in value, they sometimes sell those stocks immediately despite their previously gauged risk tolerance suggesting they would not sell in a price decline. So different asset classes, different classes of assets carry different levels of risk and potential return. And the idea behind asset allocation and diversification is that because not all investments are alike, you can balance risk and return in your portfolio by spreading your investment dollars among different types of assets, such as stocks, bonds, and cash alternatives. Of course, it doesn't guarantee a profit or insure against the loss, but it can help you manage the level and type of risk that you do face. Not all assets respond to market forces in the same way at the same time. So for instance, when the return of one asset type is declining, the return of another may be growing. To combat this risk, it's important to diversify by owning a variety of assets in different asset classes. And by diversifying your portfolio, a downturn in one single holding will not necessarily spell disaster for you and your portfolio. So let's take a quick look at three major asset classes you'll generally be considering when you are putting together your asset allocation. Stocks. Stocks have historically provided a higher average annual rate of return than other investments, including bonds and cash alternatives, but are generally more volatile than bonds and cash alternatives. And investing in stocks is more appropriate if your investment goals are long-term. Bonds, of course, are usually less volatile than stocks and do not provide as much opportunity for growth. They're more sensitive to interest rate changes. So when interest rates rise, the bond values tend to fall. And the inverse is true. When interest rates fall, bond values tend to rise. So as a result, bonds redeemed prior to maturity may be worth more or less than their original cost. Because bonds typically offer fixed interest rate payments at regular intervals, they may be appropriate if you want regular income from your investments. And cash alternatives, or short-term instruments, offer lower potential for growth than other types of assets, but are the least volatile. They are subject to inflation risk, which is the chance that returns won't outpace rising prices. They provide easier access to funds as opposed to longer-term investments, and may be appropriate for investment goals that are more short-term. So taking it a step further, you can diversify within asset classes into sub-asset classes. So for example, when investing in stocks, you can choose to invest in large companies or large cap, or what we call large cap. Those tend to be less risky than small companies, which are called small cap. Or you can choose to divide your investment dollars according to investment style, investing for growth or investing for value. So the investment possibilities are limitless. Your objective is always the same, and that is to diversify by choosing complementary investments that balance risk and reward within your portfolio. So I called this on the presentation, build your portfolio, but it's really build or reassess your portfolio. So choose specific investments for your portfolio that match your asset allocation strategy. This is much less important than the asset allocation question, but is also more complex because of virtually unlimited investment options that exist. Mutual funds and ETFs make this easier by providing automatic diversification, professional management, and potentially lower costs. But it's important to note that when investing in a mutual fund, you must consider its investment objectives, risks, fees, and expenses, all of which can be found in the fund's prospectus, which should be read before investing. So when building and reviewing your portfolio, be sure to look at all of your investments as a whole to help understand not only the allocation and objective for that one particular account, but also how your entire portfolio is allocated. And lastly, pay attention to your portfolio. It's important to revisit your asset allocation at least and rebalance your allocation at least on an annual basis. Because of market fluctuations, your portfolio may no longer reflect the initial allocation balance that you chose. So for instance, if the stock market has been performing well, eventually you'll end up with a higher percentage of your investment dollars in riskier stocks than you initially intended. To rebalance, you may want to shift funds from one asset class to another. And in some cases, you may want to rethink your entire allocation strategy. If you're no longer comfortable with the same level of risk, your financial goals have changed, or you're getting closer to the time when you'll need the assets, you may need to change your asset mix. Number 3, contribute to your retirement plans. So this slide is most applicable to those who are not yet in retirement. And for those of us who are not yet in retirement, we tend to be very idealistic about retirement, dreaming about all the things that we never seem to have time to do now. But how do we pursue that vision? Social Security may not be around when we retire, but the benefit you get from Uncle Sam may not provide enough income in retirement years. To make matters worse, few employers today offer a traditional company pension plan. Of course, the exception is the military pension if retirement occurs. So with the military pension plan, it guarantees you a specific income at retirement. But for those of us who are not eligible for that, there are few employers offering that. And on top of that, people are living longer, and they must find ways to fund those additional years of retirement. So these eye-opening facts mean that today, sound retirement planning is critical. There is good news. Retirement planning is easier than it used to be, thanks to the many tools and resources available. So here are some basic steps to get you started. First, determine your retirement income needs. It's common to discuss desired annual retirement income as a percentage of your current income. Depending on who you're talking to, that percentage could be anywhere from 60 to 90% or even more. The appeal of this approach lies in its simplicity. The problem, however, is that it does not account for your specific situation. Your current expenses are a starting point, but you have to note that your expenses may change dramatically by the time you retire. If you're nearing retirement, the gap between your current expenses and your retirement expenses may be small. However, if retirement is years away, that gap may be more significant and projecting your future expenses may be difficult. Remember to take inflation into account. The average annual rate of inflation for the past 20 years, according to the Consumer Price Index, has been 2.2%. And keep in mind that annual expenses may fluctuate throughout retirement. For instance, if you own a home and are paying the mortgage, your expenses will drop if the mortgage is paid before retirement. Other expenses, such as health-related expenses, may increase in your later retirement years. A realistic estimate of your expenses will tell you how much yearly income you'll need to live comfortably. So then calculate the gap between needs and estimated future income. So once you've estimated your retirement income needs, take stock of your estimated future assets and income. These may come from Social Security, a retirement plan at work, a part-time job, or other sources. If estimates show that your future assets and income will fall short of what you need, the rest will have to come from additional personal retirement savings. So if you've calculated a gap between needs and future income, you'll need to figure out how much you need to save. But exactly how much is enough? The following questions may help you find the answer. At what age do I plan to retire? Obviously, the younger you retire, the longer your retirement will be, and the more money you'll need to carry through retirement. What is your life expectancy? The longer you live, the more years of retirement that you'll have to fund. And what is the growth rate you can expect from your savings now and during retirement? Be conservative when projecting rates of return. Do you expect to dip into your principal? If so, you may deplete savings faster than if you just live off investment earnings. Be sure to build in a cushion to guard against these risks. So build your retirement fund. Save, save, save. When you know roughly how much money you're going to need, your next goal is to save that amount. First, you'll have to map out a savings plan that works for you. Assume a conservative rate of return, for example, 5 or 6%, and then determine approximately how much you'll need to save every year between now and your retirement to reach your goal. The next step is to put your savings planning into action. It's never too early to get started, and to the extent possible, you may want to arrange to have certain amounts taken directly from your paycheck and automatically invested in your choice of savings. So for instance, TSP, 401k. This arrangement reduces the risk of impulsive or unwise spending that threaten your savings plan. I like to say out of sight, out of mind. If possible, save more than you'll think you'll need to provide a cushion. Of course, understand your investment options. You need to understand the investments that are available and decide which ones are right for you. If you don't have the time, energy, or inclination to do this yourself, we recommend hiring a professional. He or she will explain the options that are available to you and can assist you in selecting investments that are appropriate for your goals, risk tolerance, and time horizon. Obviously, many investments involve the risk of loss of principal. So I just wanted to cover a couple of most common retirement savings tools, but there are also others available. So employer-sponsored retirement plans that allow employee deferrals. These are TSP, 401k, 403b, simple, and 457 plans, all powerful savings tools. Your contributions into these accounts come straight out of your salary as pre-tax contributions, which reduces your taxable income. And investment earnings are tax deferred until they are withdrawn. These plans often include employer matching contributions and should be your first choice when it comes to saving for retirement. So the TSP, the 401k, the 403b, and the 457 also allow for after-tax Roth contributions. These are usually kept in separate accounts. So for instance, the TSP has the availability to do a Roth TSP or a traditional TSP, and they are kept separately. So while Roth contributions don't offer an immediate tax benefit, qualified distributions from your Roth account are federally income tax-free, right, because we paid the tax already when we made the contribution, and are not subject to required minimum distributions. These accounts, whether it's traditional or Roth, these accounts have maximum annual contribution amounts and allow for catch-up contributions for those who are age 50 and above. So in addition to your employer-sponsored retirement plans, which we just talked about, the 401k, 403b, 457, and TSP, you can also contribute to a traditional IRA or a Roth IRA of up to $5,500 for those who are below the age of 50, and $6,500 for those who are above the age of 50 and above. And so this is an unchanged amount from 2017. That's a 2017 contribution limit, as well as 2018. For both the Roth and the traditional IRA contributions of the $5,500 and $6,500, this is based on eligibility, which is based on your income. So before contributions are made, it's important to verify whether or not you're eligible via the IRS website. So you can go to the IRS website and check your income brackets, and if you're eligible, you can contribute. If you're not, you are able to contribute to a traditional IRA but not take deductions. So if you are eligible, traditional IRAs will enable you to lower your current taxable income through deductible contributions, and earnings are tax deferred. Of course, withdrawals are generally taxable as ordinary income. Roth IRAs do not permit tax-deductible contributions, but allow you to make completely tax-free withdrawals under certain conditions. With both types, you can typically choose from a wide range of investments to fund your IRA. Finally, annuities are contracts issued by insurance companies. Annuities are generally funded with after-tax dollars. Their earnings are tax-deferred, and there's generally no annual limit on contributions to an annuity. A typical annuity offers income payments beginning at some future time, which is usually retirement. The payments last for your life or for the joint life of you and a beneficiary, or for a specified number of years. Annuities may be subject to certain charges and expenses, including mortality charges, surrender charges, administrative fees, and other charges. So that is it on this one. We can move to number 4, which is take your RMD. So for those of you already in retirement, by now, hopefully you've already taken all of your required minimum distributions. If not, be sure to do so before December 31st to avoid penalty. You must take your first RMD for the year in which you turn 70 and a half. However, the first payment can be delayed until April 1st of the following year in which you turn 70 and a half. So when it's time to take IRA distributions, be sure to add up all of your IRAs to determine your RMD amount. Once you add up all of your IRAs, you will use the IRS mortality life expectancy table to determine the appropriate divisor you must take or you must use to determine the RMD you must take. In retirement, one of the biggest risks is outliving our assets. So it's important to determine a safe withdrawal amount to mitigate against longevity risk. This can be estimated using retirement calculators, but we always recommend seeking professional advice to assist you. When it comes to RMDs and tax penalties, none of us want to pay any more taxes than we already do, so be sure to take your RMD on time and avoid penalties. If an RMD is not taken in the required year, the amount not withdrawn is taxed at 50%. Also, decide on a source. An overlooked component to RMD withdrawals is determining which investments you should sell or draw from. Consider factors such as risk tolerance, taxes, income needs, and current economic conditions when deciding on a source to withdraw. Lastly, monitor your withdrawal amount. The IRS rules tell you how much you must withdraw, but not how you should withdraw to accomplish your financial goals. Number 5. Year-end tax planning. So this is a hot topic here. Before I get started on this number here, I just wanted to mention that we did upload a summary tax grid outlining the changes by category, and it compares the previous tax law with the new law. So I think most of you would find that very helpful and interesting. I forgot to mention that in my morning webinar, so be sure to download that. So as the end of the year approaches, it's a great time to consider strategies that would help you reduce your tax bill. But most tax tips, suggestions, and strategies are of little practical help without a good understanding of your current tax situation. And this is particularly true for year-end planning. You can't decide where to go next if you don't know where you are now. Of course, the last quarter has been a wild ride with the roller coaster tax reform bill, and a final version was approved finally in mid-December, giving us little time to make adjustments to our tax plan. The bill changes rates, deductions, saving incentives, estate planning, and business taxation, as you will see from the grid. And there are many online calculators to help you assist in estimating the tax impact that the new bill will have on your situation. We also recommend consulting with a tax professional to understand how these changes will affect you. So I encourage all of you to take a break from holiday chores and pull out last year's tax return along with your current pay stubs and account statements and do a few quick projections that will help you estimate your present tax situation and identify any glaring issues you'll need to address while there's still time. When it comes to withholding, be sure to not shortchange yourself. If you project that you'll owe a substantial amount when you file this year's income tax return, ask your employer to increase your federal income tax withholding amounts. If you have both wage and consulting income and are making estimated tax payments, there's an added benefit to doing this. Even though the additional holding may need to come from your last few paychecks, it's generally treated as been having withheld evenly throughout the year. And this may help you avoid paying estimated tax penalty due to underwithholding. Of course, if you've significantly overpaid your taxes and estimate you'll be receiving a larger refund, you can reduce withholding accordingly, putting money back into your pocket this year instead of waiting for your refund check to come next year. Timing is everything. The last few months of the year may be the time to consider delaying or accelerating income and deductions, taking into consideration the impact on both this year's taxes as well as next. If you expect to be in a different tax bracket next year, doing so may help minimize your tax liability. So for instance, if you expect to be in a lower tax bracket next year, you may want to postpone income from this year to next so that you will pay tax on it next year instead. At the same time, you may want to accelerate your deductions in order to pay less tax this year. And under the new tax law, higher standard deductions will cause more people to take the standard deduction instead of itemizing. If you fall into this group, you have good reason to accelerate deductions in 2017. So to accelerate deductions into this year, here are a few considerations. Consider paying medical expenses in December rather than January. Doing so will allow you to qualify for the medical expense deduction. Prepay deductible interest. Make alimony payments early. Make next year's charitable contributions this year. An alternative to that is bunching future donations so that every few years it's possible to surmount the higher threshold and use a deduction. Consider prepaying your state and local taxes for 2018 if your local tax authority will allow it. For those who will exceed the $10,000 state and property tax return deduction, this may be beneficial for you to contact your local tax authority to determine if they will accept prepayments. in 2017 for 2018. And then to delay income into the following year if you think you might be in a lower tax bracket. So defer year-end bonuses, defer the sale of capital gain property, or take installment payments rather than lump sum payments, postpone receipt of distributions other than required minimum distributions, and postpone considering Roth conversions. Now, gifts. If you itemize your deductions, consider donating money or property to charity before the end of the current year in order to increase the amount you can deduct on your taxes. You may also give up to $14,000 per individual. That's twice. You can double that if you're married, to as many individuals as you want without incurring any federal gift tax consequences. If you gift appreciated property, you won't have to pay any taxes on the gain, and any tax is deferred until the recipient of your gift disposes of the property. Postpone the inevitable. Recall tip number 3, contribute to your retirement plans. To reduce taxable income this year, consider maximizing pre-tax contributions to an employer-sponsored retirement plan such as your 401k. I do realize we're in the last few days of December, so this might be difficult, but you won't be taxed on those contributions you make now, and you may be in a lower tax bracket when you eventually withdraw the funds and report the income. So if you qualify and you still do have time, you may want to consider either making tax-deductible contributions. You may want to consider that or making tax-deductible contributions to a traditional IRA. You generally have until the due date of your federal income tax return to make the deductible IRA contributions. So I understand tax planning can be complicated, especially this year, but I encourage you to consider seeking the assistance of a tax professional to help determine what year-end planning moves, if any, are right for you and your individual circumstances. Number 6, update your budget. So I'll tell you, as a financial planner, this topic is the most dreaded, but yet the most necessary. It's a vital part of planning and financial success. So that being said, with the new year just a few days away, I encourage you to ask yourself, when is the last time you created a budget? If you've never created a budget or haven't taken a recent look at yours, you may want to establish a budget to help you keep track of how you spend your money and how to help you reach your goals. So let's first talk about how to create a budget. For simplicity, I'm going to break it down in a few easy steps. Number 1, examine your financial goals. So we talked a little bit about this on the first slide. I encourage you to look at make a list of your short-term goals as well as your long-term goals, and ask yourself, how important is it for me to achieve this goal? How much will I need to save? Armed with that clear picture of your goals, both short-term and long-term, you can work towards establishing a budget that can help you reach them. Step 2 is identify your current monthly income and expenses. Creating a budget that works for you is key. Use whatever method you will find suitable, whether that be pen and paper, Excel, or a software program such as Quicken. And I'm going to spend some time on the very last slide talking about a software program we offer, complimentary, called Financial Dashboard. But nowadays, there are many solutions, and many banks offer the ability to categorize your spending with use of a drop-down, which can be helpful in examining your patterns. So start by adding all of your income to include salary, wages, and other types such as dividends, interest, and child support. Next, add up all of your expenses. This is probably the most challenging part for most people. And breaking down your expenses into 3 categories: fixed, flexible, and occasional. So fixed expenses are items such as rent, mortgage, car payments, utilities, insurance. And then one thing that people often forget about is monthly savings, because we have to pay ourselves first. So include that in your fixed expenses. Flexible expenses are entertainment, household goods, gas, hobbies, and then occasional expenses are items you purchase periodically, such as gifts, vacations, car maintenance, home maintenance. And when thinking about your expenses, be sure to include expenses from all spending accounts, including credit cards. Step 3, evaluate the budget. So once you've added up all of your income and expenses, compare the two totals. Obviously, to get ahead, you should be spending less than you earn, and if this is the case, you're right on track. And you need to look at how well you use your extra income. If you find yourself spending more than you earn, you'll need to make some adjustments. Look at your expenses closely and cut down on your discretionary spending. Remember, if you find yourself coming up short, don't worry. All it takes is time, a little determination, and a little self-discipline, and eventually you'll get it right. And then 4, monitor your budget. You'll need to monitor this periodically to make sure that you're making changes as necessary. It's important to keep reasonable track of your expenses, but keep in mind that you don't have to keep track of every single penny that you spend. And remember to be flexible. Any budget that is too rigid is likely to fail, so be prepared for the unexpected. So with that, here are some quick tips on staying on track when it comes to budgeting. 1 is to involve the entire family. Agree on a budget up front and meet regularly to check your progress. As discussed, there are many formats for budgeting. Choose the best one that works for you. Stay disciplined. Try to make budgeting a part of your daily routine. Start a new budget at a time when it will be easy to follow and stick with the plan. So for example, at the beginning of the year, rather than right before the holidays. Find a budgeting system that fits your need. I already talked about that, either pen and paper budgeting software or Excel. Distinguish between expenses that are wants versus expenses that are needs. Build rewards into your budget, so that may be eating out every week or every other week, and include a budget for those rewards. Avoid using credit card payments for everyday expenses. If you do use credit cards for everyday expenses to redeem rewards, cash back, or other benefits, be disciplined and pay those amounts off each week. There are some individuals who are very good at this, but others who are not. So know yourself and your habits and do what works best for you. Number 7. So my final recommendation, number 7, is to invest extra income. Investing extra income may seem like a no-brainer, but for most of us, this can be very difficult. And I first want to address savings versus investing, and then I'll review some helpful tips on how to invest more. So you must plan to invest. And why do so many people never obtain the financial independence that they desire? Often, it's because they don't take that first step, which is getting started. Besides procrastination, other excuses people make are that investing is too risky, too complicated, too time-consuming, or only for the rich. And the fact is that there's nothing complicated about common investing techniques, and it usually doesn't take much time to understand the basics. One of the biggest risks you face is not educating yourself about which investments may be able to help you pursue your financial goals and how to approach the investing process. So savings versus investing. Both savings and investing have a place in your finances, but it's important not to get the two confused. Saving is the process of setting aside money to be used for a financial goal, whether that's done as a part of a workplace retirement savings plan, an individual retirement account, a bank savings account, or some other vehicle. And investing is the process of deciding what to do with those savings. So why invest? Well, you have to invest for your future, and the future is expensive. For example, people are living longer, retirement costs are often higher than most people expect. and you have to take responsibility for your own finances, even if you need expert help to do so. As discussed at the beginning of the presentation, government programs such as Social Security will probably play a less significant role for you than they did for previous generations. Corporations are switching from guaranteed pensions to plans that require you to make contributions and choose investments. And the better you manage your dollars, the more likely it is that you'll have money to make the future what you want it to be. And because everyone has different goals and expectations, everyone has different reasons for investing. Understanding how to match those reasons with your investments is simply one aspect of managing your money to provide a comfortable life and financial security for you and your family. So, before you start, organize your finances to help manage your money more efficiently. Remember, investing is just one component of your overall financial plan. Get a clear picture of where you are today. What's your net worth? Compare your assets with your liabilities to find out. And recall recommendation number 6, update your budget. Look at your cash flow. Be clear on where your income is going each month and list your expenses. You can typically identify enough expenses to account for at least 95% of your income. If not, go back and look again. You could use those lost dollars for investing. If you're drowning in credit card debt, pay off those as quickly as possible before you start investing. Every dollar you save in interest charges is one more dollar you can invest for the future. Establish a strong, solid financial base. Make sure you have an adequate emergency fund. 3 to 6 months is the recommendation. Sufficient insurance coverage and a realistic budget. Also, take advantage of benefits and retirement plans that your employer offers. So what is the best way to invest? Get in the habit of saving. Set aside a portion of your income regularly and automate that process if possible by having money automatically put into your investment account before you have a chance to spend it. Invest so that your money at least keeps up with inflation over time. Don't put all your eggs in one basket. Recall recommendation number 2, review your asset allocation. Though asset allocation and diversification don't guarantee a profit or insure against the possibility of loss, having multiple types of investments may help reduce the impact of a loss on any single investment. Focus on long-term potential rather than short-term price fluctuations. Ask questions and become educated before making an investment. And finally, invest with your head, not your stomach or heart, and avoid the urge to invest based on how you feel about an investment. And then understand the impact of time. Take advantage of the power of compounding. Compounding is the earning of interest on interest or the reinvestment of income. So for instance, if you invest $1,000 and get a return of 8%, you will earn $80. By reinvesting the earnings and assuming the same rate of return the following year, you will earn $86.40 on your $1,080 investment. The following year, $1,166.40 will earn $93.31. Use the rule of 72 to judge an investment's potential. Divide the projected return into 72, and the answer is the number of years that it will take for an investment to double in value. For example, an investment that earns 8% a year will double in 9 years. Consider whether you need expert help. If you have the time and energy to educate yourself about investing, you may not feel like you need assistance. However, for many people, especially those with substantial assets, multiple investment accounts, it may be worth getting expert help in creating a financial plan that integrates long-term financial goals such as retirement with other more short-term needs. And review your progress. Financial management is an ongoing process. Keep good records and recalculate your net worth annually. This will help you for tax purposes and show you how your investments are doing over time. Once you take that first step of getting started, you'll be better able to manage your money to pay for today's needs and pursue tomorrow's goals. Finally, here are some few extra tips that will help you invest more. My first tip, which you've heard before, pay yourself first. Set up automatic deductions from your paycheck that go into your investment accounts and use the remainder to pay for current living expenses. If you're managing your budget well at your current income level, don't spend the windfall income. Invest your tax returns and bonuses. Diversify your income stream. Family dependence on one paycheck is risky. What happens to your budget and investment plan if you lose your job? As a family, think creatively about additional income streams you can create for your family, such as getting a second job, starting a consulting business, or renting out assets you own. Once that additional income is flowing in, you can invest it. So, as a review, today we covered 7 ways to improve your personal finances. Many of the topics we covered today are very simple approaches to assist with organization and accountability of your own financial future. With the end of the year approaching, there's no better time to get organized and plan ahead for 2018. At AAFMAA Wealth Management and Trust, we offer a helpful and comprehensive tool to help you with many of the discussion points we talked about today. We call it the Financial Dashboard. It's an online tool through our software program, eMoney, which is the same software we use for all of our comprehensive financial plans. Access to the Financial Dashboard is secure and again at no cost to eligible members. It's a great tool we offer to help you become more financially successful. So the Financial Dashboard allows you to aggregate all of your financial accounts, including insurance, investments, retirement, and banking. An account aggregation allows you to view your holistic financial picture. Through the use of the dashboard, I listed some bullet points of things you can do here. Create a customized budget to help you control spending. You can securely track asset gains and losses in near real time across your entire portfolio. Monitor your asset allocation and manage cash flow through custom alert settings. The Financial Workshop has a very good education center with videos and articles and has several planning calculators on asset allocation, budgeting, retirement planning, college savings, and insurance planning. So you can request access to the Financial Dashboard by clicking on the link on your screen. And again, as the new year approaches, we just encourage you to think about your financial plan. If you have not yet created a financial plan and would like to know more about our planning process, I encourage you to reach out to me or any one of us at AAFMAA Wealth Management and Trust. All of us are happy to help. So Kevin, with that, I will turn it back over to you, and if we have any time for questions, we can take those.
Perfect. Excellent. Thank you so much, Brittany, and thank you for such a comprehensive overview. I hope everybody listening was able to get something out of that. We are now going to open it up to you for questions in the audience. We've collected a bunch of questions already, but please don't hesitate to submit your own by typing them in the questions block in the panel on your screen. Again, your phones are going to be muted throughout. So I will go ahead and share some of these questions that we've picked out with Brittany now, and we'll go ahead and get started with, so Brittany, if I'm in that 70.5 range and I'm still working, do I still have to take those required minimum distributions or the RMDs?
So the answer to that is yes and no. If you are of RMD age, but you are still working, you do not have to take RMD distributions from your current employer's 401k plan. However, you do have to take RMD distributions from IRAs that you may have outside of your current employer or any former employer's 401k plans. So the only exemption there is that you can eliminate your current employer's 401k plan. You do not have to take RMDs from that account.
Great, excellent. The next question is sort of topical and interesting. The markets are making me nervous. How should I position my portfolio, considering the huge run up in the stock market, but interest rates are rising? What should I do?
Sure. So I think that's a very personal question, and like I touched on before, what to do has it depends on your personal situation, your risk tolerance, your time horizon. So I think that providing an answer is hard to do just with that amount of information. I would definitely need more information to provide the right answer. But what I would encourage that person to do is reach out to myself or reach out to any of us at AAFMAA Wealth Management and Trust to get guidance or a second opinion on what they should do and where they're currently at financially. I always recommend that everybody try the financial dashboard as well. I think that if people are feeling a little insecure about not knowing where they're at, it's hard to know where you want to be. So using the financial dashboard can just give you a very good, clear picture on where exactly you stand, and we can help you answer the question of where should you go now.
Great, and that's actually a good segue into another question we got here, and I'm just going to paraphrase. This person was very excited and was grateful for your presentation. Wants to know, how do they do a financial plan with Wealth Management and Trust? How does it work, and what does it cost?
Sure. So the financial planning process is very robust. It covers topics such as investments, insurance, budgeting, estate planning, but it can also be tailored to fit the client's needs. A typical financial planning engagement is 3 to 4 meetings and can last, 3 to 4 months depending on the client's timeline. The cost of the financial plan is $2,100 flat fee. That is split into 2 payments, the first half being paid in the beginning of the engagement and the second half at the end of the engagement. As far as how to get started with a financial plan, again, the best thing to do is contact myself or any one of us at the office. We can help answer any specific questions you may have about the process, and if you're ready to get started, give you the proper documents to start that engagement.
Great, and I do want to be respectful of everyone's time, so I'm just going to take one more question from the list here. And if we don't get to your question, we will contact you personally after the session is over and make sure we get your question answered. Here's a question, Brittany, can you make rollover contributions to a charity directly from an individual 401k like you can from an IRA to avoid taxes on an RMD?
So the answer to that question is no. That ability only applies to an IRA, but the way you can work around that is by transferring assets from your 401k to an IRA. So you can do this with no tax consequence by making a trustee-to-trustee transfer, moving your 401k assets, if eligible, of course, to an IRA, and then making a distribution to your charitable account. So if you're still working with that 401k, what you would have to do is contact your 401k custodian to determine the eligibility to move assets into an IRA if you're still working, with that firm's 401k.
Excellent. Well, thank you again, Brittany. That was great. And thanks to everyone for your thoughtful questions. Again, if we didn't fully answer your questions or if you think of another question later, always feel free to reach out to us at wealthmanagement@afmaa.com, or we will respond to questions that were submitted directly. We'll go ahead and break here for now, but please, again, don't hesitate to reach out to us for assistance whenever you need it. We do this every day for our military community, and it is our pleasure. This weekend, you'll receive a follow-up email with instructions on how to access a recording of this presentation. And you can always register for future webinars or review past webinars at wealth.afmaa.com. Speaking of future webinars, please be sure to join us again in 2 weeks when Art Lyons, the AAFMAA Wealth Management Trust Chief Investment Officer, presents his investment market outlook for 2018. If you found this information useful, we encourage you to please share it with your friends and family. Our membership grows stronger every year because you introduced those in your military community to AAFMAA. So thank you again to everyone for listening and for joining us today. We look forward to our next opportunity to assist you.